There is a verse in Proverbs 9:20 p.m. that most people walk past without stopping. Solomon wrote it, and it reads like household advice. Precious treasure and oil are in the dwelling of the wise, but a foolish person devours it. On the surface that sounds like a tip about not eating your leftovers. But when you understand the economic world, Solomon was operating in a world of caravans, tribute, trade monopolies, and annual gold deliveries from Ophir, you begin to realize he was not describing a pantry, he was describing an architecture. The storehouse in Solomon's framework was not a room. It was a relationship between a household and its resources, a relationship that determined whether the household was sovereign or dependent. And the reason modern banks do not want you thinking about that relationship is because the moment you understand it, you become their competition. Let us establish the ground first. In 1150 CE, the Knights Templar did something that changed the economic history of the Western world. Christian pilgrims traveling to Jerusalem faced a brutal logistical problem. Carrying gold across thousands of miles of hostile territory invited robbery and death. The Templars solved it with a system so elegant it still forms the skeleton of modern banking. A pilgrim would deposit gold at a Templar preceptory in France, receive a letter of credit, travel to Jerusalem, present that letter, and receive equivalent gold on the other side. No gold physically crossed the Mediterranean. The Templars held the reserves. They controlled the letters. They collected the fees. What they had done with total awareness of what they were doing was take the ancient storehouse concept and institutionalize it. They removed the storehouse from the household and placed it inside an institution. The household became a depositor. The institution became the sovereign. This is not ancient history. This is the exact model that governs your checking account right now. Every financial system since the Templars has been a variation of the same trade. You surrender possession of your stored wealth to an institution, and that institution gives you a representation of it, a balance, a statement, a number on a screen, while deploying the actual wealth to generate returns for itself. The critical point that most people are never taught is that when you deposit money in a commercial bank, you have legally transferred ownership. Your deposit becomes the bank's asset. You become what is called an unsecured creditor, meaning in a systemic failure. You stand in line with every other creditor, behind secured creditors, behind bondholders, behind anyone with a stronger legal claim. This is not speculation or conspiracy. It is a foundational principle of banking law confirmed in the legal frameworks of virtually every Western nation. The money is not yours the moment it crosses the counter. You have entered the Templar relationship, except the Templars at least gave you a certificate. Solomon's protocol refuses that trade entirely. To understand why, you need to go back further than Solomon to Joseph. In Genesis 41, Pharaoh has a dream that no one in Egypt can interpret. 7 fat cows are devoured by 7 gaunt ones. 7 full heads of grain are swallowed by 7 withered ones. Joseph, brought from prison to stand before Pharaoh, gives an interpretation that is also a financial strategy in disguise. 7 years of abundance are coming, followed by 7 years of famine. The wise response is to collect 1/5 of all harvest during the years of abundance and store it in cities, not distribute it, not spend it, not lend it out at a margin, store it, under administrative control, as a reserve against the crisis that has not yet arrived. Pharaoh implements the plan. Egypt survives. Every surrounding nation that did not build a storehouse comes to Egypt with their silver, then their livestock, then their land, then themselves, just to eat. Joseph's storehouse did not merely save Egypt. It converted the surrounding world from independence to dependency, one famine year at a time. Egypt became the lender. Its neighbors became the borrowers. The storehouse was the mechanism of that conversion, and it happened without a single military campaign. This is the architecture Solomon inherited, and what he did with it was more sophisticated than any financial system of his age. The text of 1 Kings 9 and 10 describes a household, meaning a royal economy that generated income through at least 5 simultaneous channels: tribute from vassal kingdoms, trading fleets in partnership with Hiram of Tyre sailing to Ophir for gold, land-based trade routes running caravans between Egypt and Asia Minor, domestic agriculture and construction projects generating internal economic activity, and a reputation for wisdom so powerful that foreign rulers brought gifts simply to sit in his presence. the Queen of Sheba arrived with 120 talents of gold, spices, and precious stones before Solomon said a word to her. His storehouse attracted resources the way a functioning institution attracts investment because it was visibly, demonstrably productive and stable. His annual income of 666 talents of gold was not the result of aggressive taxation. It was the result of positioning. Solomon understood that the nation with the storehouse sets the terms. The nation without it accepts them. Deuteronomy 12, which Solomon would have known by heart, states the principle with the directness of a legal contract. The Lord will open to you his good storehouse, the skies, to give rain to your land in its season, and to bless all the work of your hands. You shall lend to many nations, but you shall not borrow. Not you probably will not borrow. Not you should try to avoid borrowing. You shall not. It is framed as a structural outcome of a particular way of managing resources, not as a moral suggestion. The storehouse produces the lender. The absence of the storehouse produces the borrower. The equation is that direct. Now consider what the modern financial industry has done with this equation. It has reversed it, systematically and deliberately, using a set of psychological and structural tools that most people never recognize as tools. The first tool is normalizing consumption over storage. From the earliest age, children in consumer economies are taught that money is for spending. Advertising is a $3 trillion industry built almost entirely on converting stored wealth into immediate consumption. The economy requires this. If every household began operating a storehouse retaining 20 or 30% of income as productive reserves, the velocity of consumer spending would drop, and with it the fee income that commercial banks generate from credit card debt, auto loans, personal lines of credit, and revolving balances. The industry's business model depends on your storehouse remaining empty. That is not a conspiratorial framing. That is a direct observation of the incentive structure. The second tool is the myth of dead money. You have heard this phrase in some form: cash sitting in a savings account is losing value to inflation. This is partially true and deployed completely dishonestly. Yes, holding idle cash in a zero-interest account is a losing position in an inflationary environment. But the conclusion drawn that you should therefore deploy all available capital into market-exposed instruments is a logical leap designed to move your reserves out of your household's control and into the financial industry's control. The alternative Solomon operated was not idle cash. It was productive storage assets that retained and generated value while remaining accessible. His grain reserves fed armies, funded trade expeditions, and provided political leverage. His gold and cedar stores served as diplomatic currency. His fleet investments generated returns on 3-year cycles. Not one of those reserves was idle. Each was deployed within the household's own economic architecture, not surrendered to an external institution. The third tool is the suppression of the velocity concept. Money that moves through your household multiple times before leaving it creates a compounding effect that institutional banking wants to capture for itself. Here is a simple illustration. A household earns income. It deposits that income in a bank. The bank lends it to another customer at interest. That customer spends it. It is gone from the household's economy permanently, except for whatever fractional interest the bank returns as savings yield. Now consider the storehouse alternative. The household earns income. It deposits a portion into a controlled reserve, a cash value life insurance policy, a privately held note secured by real estate, a family lending structure. A family member needs a vehicle. Instead of financing through a bank, they borrow from the household reserve and repay it with interest. The interest returns to the household. The household's capital has now done two things: funded the vehicle and collected interest income. The money has moved through the household twice before leaving. That is velocity. Nelson Nash called this becoming your own banker and built an entire financial philosophy around it. But the concept predates Nash by millennia. It is the operational logic of every functional storehouse from Joseph's Egypt to Solomon's Jerusalem to the Medici banking houses of 15th century Florence. The Medici case is instructive for a specific reason. Giovanni di Bicci de' Medici, the founder of the Medici banking family, did not become powerful by building a bigger bank than his competitors. He became powerful by structuring his household's financial architecture so that it was never dependent on a single institution, a single market, or a single political relationship. The Medici Bank maintained branches in multiple cities, held assets in multiple currencies, financed trade rather than just lending, and kept household reserves that were distinct from the bank's operating capital. When competitors collapsed, and many did, catastrophically, during the banking crises of the 14th and 15th centuries, the Medici household survived because its storehouse was not coextensive with its bank. The reserve existed outside the system that was failing. This is the resilience principle of Solomon's protocol. The storehouse must never be fully visible to, or accessible by, the same institutions that handle your daily transactions. Thomas Stanley spent decades studying American millionaires and documented his findings in The Millionaire Next Door. One of his most striking observations was that the households with the highest net worths were consistently not those with the highest incomes. They were the ones with the highest savings rates, the lowest visible consumption, and a structural tendency to store before spending. The median American millionaire, not the hedge fund manager, but the owner of a small business, the engineer who has been investing since his first paycheck, lives in a house worth less than his net worth, drives a used car, and maintains liquid reserves that most high-earning peers would dismiss as excessively conservative. Stanley called this the defense of wealth. What he was describing in secular terms was a household operating a storehouse. The behavior is identical across 3,000 years of wealth preservation literature. Store first, spend from surplus, protect the reserve as a sovereign asset. The practical implementation of Solomon's protocol for a modern household follows the same logic Joseph applied in Egypt, just scaled down. You need to identify your current income-to-storage ratio. Most households, across income levels, store between 0 and 5% of income. The protocol requires a minimum of 20% directed into productive reserves before any discretionary spending occurs. This is not the same as saving. Saving is passive money parked in a low-yield account, waiting. Productive storage is active capital positioned in instruments that retain value, generate yield, and remain accessible without penalty. This can be whole life insurance with a cash value structure, short-term government instruments laddered for liquidity, a real estate note, a private lending arrangement, or any combination that keeps the capital inside the household's economy and earning rather than depreciating. The exact vehicle matters less than the structural discipline. The reserve exists, it grows, and it is never the first source of funds for consumer needs. The second element of implementation is separation of purpose. The single checking account, the one most households run their entire financial lives through, is the storehouse's enemy. When all money occupies one container, it has no identity. It is all equally available for any purpose, which means it is all equally available for consumption. The wise household runs multiple containers with fixed purposes: an operating account for monthly expenses, a reserve account for the storehouse function, a growth account for long-term capital deployment, and a giving account, because every functioning storehouse in the biblical record, from Joseph's Egypt to Solomon's treasury to the Proverbs 31 household, gave before it consumed. Giving was not the residual of abundance. It was the architecture's first allocation, built in before the distribution began. The psychological dimension of this protocol is as important as the structural one. The reason most people do not build storehouses is not financial illiteracy. It is the low-grade, permanently installed belief that the storehouse is something only wealthy people can maintain. This belief is manufactured. It serves the consumer credit industry. The truth, which Solomon encoded in Proverbs 9:20 p.m., and which every study of long-term wealth building has confirmed since, is that the storehouse creates the wealth rather than following it. The discipline of storing before spending even small amounts, even in the beginning when the sums feel insignificant, builds the neural and behavioral architecture that scales upward. The household that learns to manage a storehouse of $500 develops the orientation that later manages a storehouse of $500,000. The amounts are not the issue. The relationship to reserve is. What banks understand, and what they invest heavily in you never understanding, is that a storehouse-building household eventually crosses the threshold. It stops carrying balances. It stops paying interest. It starts earning interest. It stops being a consumer of financial products and starts being a producer of financial leverage. The moment a household crosses that line, the moment it moves from the borrower column to the lender column, it exits the industry's most profitable demographic. It is no longer a revenue source. It becomes in the most literal sense of Deuteronomy 12, a lender among its neighbors, its community, its generation. Solomon did not build the most sophisticated treasury in the ancient world by accident. He built it by understanding, from the time he was young, that the storehouse was not a reward for success. It was the method of achieving it. The protocol is available to any household willing to apply it. The only thing standing between your household and your storehouse is the decision to begin.